Thanks for joining me. I'm Sasha Evdokov, and in this episode, I want to cover the pros and the cons of penny stocks. And penny stocks are hugely attractive, and they're great for certain types of traders, and they're horrible for other types of traders. So in this episode, I want to cover those pros and cons, so that way you can make a rational decision to see if penny stocks are right for you. Now, there are advantages and disadvantages to all sorts of different trades out there, and you need to really look inside yourself to see if penny stocks are the right types of trades for you. But the first concept I want to talk about is the low price. They are cheap, and they are cheap for a reason. And with the cheap price goes along with the get rich quick mentality. So a lot of people that get into penny stocks think that, hey, I can buy 1,000 shares, 5,000 shares for just a couple $100. I can buy, tons and tons of shares to where if the stock price just goes up just $1, then I'll make a fortune. That's the way that they think about it. They think about it that, hey, if I put in $2,000, $3,000, and if the stock, all it has to do is go up $1, just $1, and then I'll sell it, I'll make my $50,000, $100,000, or $500,000. And this is kind of like looking for the golden goose to lay that golden egg. And you really have a better chance of getting struck by lightning than to have a penny stock, that you pray and hope and dream about to go up a handful of dollars, or to use this system and thinking of this rationale. Just usually doesn't happen. Now, yes, you can make great money trading penny stocks, and yes, if you know and understand what's happening behind stocks, you can make great money in the marketplace. But you really need to understand the core basics, the foundational premise of why these stocks are going up, or most of the time they really should be short. Penny stocks are cheap for a reason, and most of the time what I always say is they should be shorted rather than going long on the penny stocks. So with this in mind, that they're cheap for a reason, you have to be mindful that even though they're cheap, that doesn't make them great buys or great investments or even great trades. So know and understand what you're getting into before you get into it, rather than thinking and hoping about these big dreams. Just because it's cheap doesn't make it better. Manipulation is the next thing I want to cover, and with cheap prices, manipulation is much easier. And this is because people are able to purchase a lot more shares. So for example, if you just go ahead and spend $10,000 or $100,000, then you can easily move that stock. You can move that stock quite a few points. And if you take a look at a video called Kramer Manipulation on YouTube, you'll see that these money managers will put in, a couple $1 million just to move the stock. And this happens much more frequently with penny stocks because it takes less capital to move these stocks. So you are more prone to manipulation. So you don't know when this move is happening, if it's being manipulated or if it's a real move that really is standing behind the company, where these people are going to hold on to their shares for quite some time. Now, from experience, I have seen most of these stocks they spike and then they sell back off with time, or they'll spike, they'll go sideways for a bit, and then they'll sell off. So this is typically what happens. Now, some of them do break out and they will hold above that level, and they may continue rising higher. But most of the time, these companies will get spiked up, they'll get popped up, and then they'll sell off over time. So manipulation is one of those things that you need to be really careful about if you're trading penny stocks. And you yourself could also technically manipulate it depending on the amount of capital that you're trading. And this is why, for me personally, I love trading the larger companies over $200-300 a share, even over $100 a share, but the ones that are very liquid, very stable companies, because you need that liquidity, especially if you're trading cheaper stocks, because you'll just move it way too much if you're just trading, $100,000 in one trade or $50,000 in one trade, depending on the price of the stock. So having that liquidity, having these capital requirements or necessary capital for the larger stocks really allow them to be a little bit of a safer investment, because you need much more capital to manipulate a stock of that size. The next concept I want to tackle is the delisting. And delisting is probably one of the things that could be really panic some moment for you if you're in a penny stock and if you're long in a penny stock and your stock gets delisted off the market. I mean, imagine. Even the huge companies have been delisted off the stock market. Think of GM, for example, has been delisted off the stock market, General Motors, and then it's been put back on. So it does happen where, companies are delisted and then put back on. But if a company gets delisted, if they're filing for chapter bankruptcy and, they're diluting all their assets and getting rid of them, getting rid of everything they have, and they're selling their furniture to be able to pay the loans, to be able to pay off those credit unions, to be able to pay off what they have in terms of assets, then you as the shareholder will probably get paid last. You even get paid, after the preferred stockholders, after the bondholders. So if you're lucky, if you get paid, you will be pretty much the last person paid if they have any money left over. But chances are you may not. And it'll be a problem trying to get out of your shares and trying to get rid of your stock on the secondary market because there's less regulation there, which is the next issue. With less regulation, you really, have these instabilities of the market. You really don't have specifics that go along with trading. So it's kind of like a friend selling shares to another friend. Now, yes, they are better on the secondary market these days, but still, it's a lot less evolved or developed than just buying or selling stock electronically with a discount broker that you can easily sign up with. Instead, you now have to do a little bit of work. It's a little more expensive. It's a little bit tougher. And that's if you actually are able to get in and out of your stock. So understand that there are a lot of risks when it comes to trading penny stocks. There's a lot of them. There's a bunch of them. And most things are not in your favor. But if you do have the experience, if you have the knowledge, the know-how, then you can capitalize on it, because then you could be the one that manipulates the stock. You could be the person that makes that stock go higher, and you can capitalize on these moves by buying a lot of shares. But I don't want to give you too much hype, because as your account grows and as your portfolio grows, once you start having $100,000, $200,000, $500,000, $1 million in your account, you will need to trade the larger stocks, because it is just too easy to move and manipulate the penny stocks. Because the minute you get in them, later when you get out of them, they will slowly sell off, or quite heavily sell off, depending on the amount of shares that you purchase. So just you getting in and out of those stocks will be much more difficult. So why not learn to trade the bigger stocks now? Why not learn to trade the stable companies, or the companies that go up $5 or $7 or $10 a day, rather than the companies that go up $1 or $2 a day? Remember, cheap stocks are cheap for a reason. If they were great investments, don't you think everybody else, or at least the very, very intelligent people, because I know there's a lot of smart people, much smarter than me, that would probably be trading those stocks, and then the price would be going up. So if you know this and you're humble about it, then stay away from the cheap stocks. But if you want to capitalize on it, if you understand what's going on, if you understand why these companies are moving, then they do create great opportunities. But you need to be watching out for them. You need to be quick on the trigger. You need to be fast to pull in to get into these stocks, and then you need to be selling them quickly, because chances are they will sell off. But you can make great returns because you are able to purchase a lot of shares. Anyways, that's just my tit for tat and comparison and what I think about them, and a little personal advice. So in retrospect, I do recommend that you trade the larger, the more stable companies, because it's easier to get in and out. It's easier to put more money and capital into these stocks. You can be hidden, you can be stealthy. For penny stocks, you may be moving them much too quickly. They can be manipulated. So there's less things in your favor in a penny stock. Now, yes, you may have these big hopes and dreams of that stock skyrocketing, or that stock going to the moon, and you do only maybe need that $1. But chances are it won't happen, and there are less things in your favor for that to happen. So stick to consistency rather for those hopes. All right, thanks for joining me. If you enjoyed this video and you want to see more videos like this one, or want to see the stocks that I'm watching in the current market conditions right now, today, then go ahead, click this link and enter your name and email address when you get to that website. And I'll be sure to send you my recaps that are sent out privately to my newsletter subscribers. And if you want to condense your trading education, if you want to speed things up and just learn how to trade the right way and save yourself some time, then take a look at some of my in-depth video courses at TRADERSFLY.com. Now remember, there's more to life than just money. So go out, do what you love, contribute to other people, and most importantly, live life abundantly. I'll see you next time.